Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a divorce, financial mediator, and business valuation expert in St. Louis, Missouri. Today, we're speaking with Amber Widener about minimizing taxes and maximizing wealth. It's really about the sunset of the Tax Cuts and Jobs Act, or TCJA, in 2025. Amber is a partner of Business Valuation and Advisory at Seidel Schroeder, providing over 2 decades of experience. She also has extensive valuation expertise, having performed hundreds of appraisals in conjunction with gift and estate tax planning, transactional advisory, which is M&A, ESOP, litigation, lending purposes. Oh my gosh, so many things. Welcome, Amber. How are you?
Doing well. Thank you for having me, Melissa. Appreciate it.
Yes. So this episode is going to kind of be all about estate planning. And I think estate planning is normally what people assume they need to do when they get old, or if they die, or all of these other types of things. But our spin is going to be looking a little bit more at what a business owner would want to consider, would want to understand about kind of the tax situation, specifically in gifting. And Amber's going to kind of guide us through some of the things that you should know. But I think just starting out, for some people, they might be like, I don't know what that Tax Cuts and Jobs Act is. And that seems like a lot of words. So we kind of will call it TCJA. But what are the major provisions of this act that are set to expire in 2025 that we would even care about as business owners?
Sure. So the TCJA was enacted in 2017. It's set to sunset in 2025, as you just said. There's a lot of provisions. It was the largest overhaul in 3 decades to the tax code. So there was a lot packed in there. So as a business owner, some of the major provisions that are relevant: one, the marginal tax rate decreased from 35% to 21% for corporations. There are also changes in depreciation, deductions, expensing, and tax credits. So one of the biggest provisions in there that I am seeing as relevant to business owners, and I'll tell you why in a minute, is the sunset of the estate and gift tax exemption. So currently, for a single individual, that exemption is about $13.61 million. So for a married couple, that's $27.22 million. So currently, that is the exemption. So if you pass away, that is the amount that is exempt from your estate, and you do not have to pay estate tax on that amount. So if this law does sunset, and we don't know, we don't have a crystal ball, but we do know that action will need to be taken for it not to sunset. So as of right now, it's supposed to sunset in 25. That exemption for gift and estate is, for an individual, going to go down, adjusted for inflation, to about $7 million. And so that's about, double that for a married couple. So that, to me, is one of the largest changes, at least for what I do. And the reason that that's so relevant, I feel, for business owners, is because I work with estate planning attorneys a lot, and many of their clients know they're in a taxable estate situation. And when I say a taxable estate, I mean they know they have assets above that threshold of the exemption. They might know that. Well, I also work with business owners in an advisory capacity. So they come in, maybe they're thinking about selling their company in a few years. Maybe they are wanting to give equity compensation to their employees, what have you. So they're coming in for a completely different purpose. And so we do an appraisal, and we kind of see where they're at from the value of their company. And as I'm looking at it, I start to realize so many of these business owners are actually in a taxable estate situation right now, or just about there, and on their growth trajectories, they're kind of hitting the threshold. And so as we're seeing this sunset, so you have a growing company combined with a sunset, that you're in a prime spot to possibly be in a taxable estate. And many business owners, it's not on their radar. And so that's what I think it's just a good thing to be aware of as a business owner, as you're starting to think about succession planning. just adding this piece onto it, because as we'll talk about it, there's a lot of pretty large tax considerations associated with this.
Well, and I think that, part of this act and some of the impact for business owners, and some people might be already sitting out there and say, okay, I don't have a taxable estate of over 27 million. But that's why we're normally seeing this with a business involved, because we will see people in startup situations. We will see people that are getting rounds of funding for companies. And this company might just be worth something right now, but it could be worth far greater in the future. So that's one scenario. And we'll kind of pepper in other types of scenarios to just like, do you see yourself in something like that? That might be a scenario where you would consider, because what is really included in this taxable estate is the stock of that company, right? And if that stock, yes, you might not have that cash right now, but is it in that stock, and is that stock growing? So talk to us about how we would even look at considering what is in our taxable estate, because we might not realize how much is in there.
No, that's a really good point. So how the IRS defines a taxable estate, it's an estate tax is your tax on your right to transfer property. So okay. I'm sure people love that they have to pay to transfer property, right? So that's what estate tax is. And it consists of everything you own. So it's going to be your real estate, your cash, your securities, your any interest that you have in businesses, insurance, those types of things, everything you own. And for business owners, the important piece of that is it's going to be the fair market value of those items, right? So it can't be as simple as saying, well, I started this business from nothing and my equity in it, is whatever, it's sweat equity. Well, that's not going to pass muster, right? And so you have to understand what your business is worth from a fair market value standpoint. And so you and I know what that is, right? We do that all the time. So what that is a qualified appraiser comes up with what the fair market value is of that company. And so they're going to do that probably, based on the methods of valuation, which we won't go into at length, but that is what the IRS considers the fair market value. It's going to be what an appraiser says is the fair market value. And that's never going to be just off the cuff. There's a very complicated analysis that goes along with it. So I think the takeaway there is that what is in your taxable estate is done at fair market value of all of those assets. It's everything you own, including your business interests. And it's very important to actually know objectively what that business is worth and what the shares are actually worth.
Well, and if conceptually what's in your taxable estate, if you're not doing tax planning or estate planning, then whatever's in your taxable estate when you die is then at fair market value when you die, is essentially what the value is. And so you come in and you look at that, or it transfers, in some capacity. But what we're talking about really has to do with transferring it at a different date. And so, or moving up the transfer, if you will. And in some cases, if you're even considering retirement or estate planning, you might be in that 5 to 10 years out that you might be selling the company, right? So in some capacity, this is usually people start thinking about this like, well, I might retire, I might exit. Who am I going to sell this to? Who am I going to transfer it to? Do I have family members? Some of those types of things are what people are thinking. But why is this sunset for, why do we even care? Because, we've had exemptions. We've had a big scare for exemptions in 2012. We had a big scare for exemptions in various years over the past decade, and this again is setting another date that it's going to end. But for this particular issue, though, for business owners, why is it important?
Right. And I think a lot of it is because it's not on the radar because it's so large. It's, and let's just talk about a single business owner for right now, for simplicity's sake. So, if I'm a business owner and I'm thinking, well, I have roughly over 13 million of exemption. So it's really not something I have to worry about, especially if I've got, 5+ years till retirement. But if we just look, and hopefully you and I will talk about why we can't trust multiples alone, but I think this is just a good exercise, just to kind of get like a framework about, the business owners I work with are brilliant people. They are hardworking. They, run successful, profitable companies, but this is just not on their radar. So even having an idea of what their adjusted EBITDA is, so earnings before interest, taxes, depreciation, amortization, EBITDA, right? Even knowing what that is might not be something that they know. But so I'm going to talk about multiples of EBITDA. So that's why I wanted to define that. So, a couple of multiples that were thrown out by GF data for Q3. So GF data, this is going to be lower middle market. So enterprise value about 10 to 500 million. That's a big range, but they said in Q3, it was about 7.5 times EBITDA. Just that's average for all industries, right? Deal Stats is another database we use. It's going to be lower or smaller companies. And then the ones that GF Data reported on we're trading average of 4.3 times EBITDA in Q4 of 23. So those are current multiples, very broad. But if we look at those multiples, we're talking about a single business owner. How the math works is we're at about a little over $900,000 of EBITDA, puts you in a taxable estate for that 7.5 multiple of EBITDA, and then about just over 1.6 million for that 4.3 for those smaller companies. So, I mean, I value a lot of companies, all range of size, range of industries, but that EBITDA number is pretty prevalent. I mean, so if you're a single business owner and you're looking kind of in that range, if your EBITDA is ending up in that range, it's something to think about. Now, I would also say probably even lower, you need to think about it because multiples are, very hard to rely on for this purpose. But that's just an illustration of an EBITDA number that can put you into a taxable estate.
Well, that's a really interesting way to look at it. I've never thought about that, but if your EBITDA is between somewhere 1.5 to 2.5, you're basically in a potential taxable estate with that 7 multiple. And again, this has to get the business owner to kind of understand, are you going to exit the business? Like, because you're going to do one of things, you're going to die owning it, right?
Yep.
Or you're going to exit the business at some point. If that amount is going to be greater in the future or is even at that amount now, it would be a good idea to take a look at, can you transfer it, right? And can you transfer it to because another way to look at it is business owner has 3 kids. One is the president, one is the secretary, one is inactive, like working at a nonprofit, right?
Sure.
So you have the 3 kids and the parents or whatever, one of the parents are still alive and they're like, I want them to prosper in the future, right? I want them to benefit because we're either going to sell it or, I want them to benefit from it, right? That's the crux of, do I let them benefit and then they have the tax burden and I don't care because I'm dead?
Yeah.
Or can I do some things in the current tax situation that could prevent that and basically move the needle so that you are transacting that business in some capacity? Even if you were to sell it to somebody else, you would almost transact it kind of now in that process. So that in some kind of capacity, that even if you have this, like the business owner has a long runway until retirement, right? Can they just ignore this? Of course you can ignore the sunset. right? Of course you can.
You can
If you
totally
want to
ignore
pay
it.
more taxes to the government or your kids or whomever, but like on top of some of the things that I've said, what do you think some other reasons why, like, again, could it be extended? Well, there would have to be other legislation and things that would have to happen. So right now we have this sunset in 2025. What can we do for the next 2 years? And why should they not ignore it,
Right. Well, and I think your example with, having, and the illustration that you had is very common. You've got a founder, several kids, one is active in the business, two are not, or maybe one's on payroll but not active in the business. I mean, the examples are, very, very numerous, right? And
Right.
so what a lot of people want to do is they want to equalize the estate. And so the one that's working in the business is going to take over the business, right? Potentially, they want to make sure that they have other assets that they're giving maybe the other heirs that are not active in the business. So we need to have an idea of what this is actually worth. And you asked about, if we have a long runway to retirement, and why is that still important? So let's say that you've got, you've got a company, and maybe it's not. It hasn't taken off yet. Mm-hmm. And I've got 5 years, and, I'm not really worried about it. Maybe 10 to 15 years. And so I just really, this is not on my radar. So if you ignore it, then, and if you are in a position where you are on a growth trajectory, I think we mentioned this before, you could very well be in a taxable estate situation and not really know it, because you don't have an objective view of what the company is worth. And the other thing I think we know, Melissa, is that we know that the laws will change. You talked that we had a scare a few years back, right? Or there's always, when there's a change in administration, there's always this upheaval. Oh, we're going to have this, big change in the tax law. So what this does in the, getting an objective opinion of value and also working with an estate planning attorney puts you in the driver's seat, because then you can be proactive. So if something changes in the law, then you can say, oh, maybe we do need to transfer some out. Maybe I need to start, giving some equity compensation to get some of this business out of my estate because we're growing at this rate and I want to retain these employees. It's a great way. It's a great, tool to use that. So I think if you have a long runway, I think you're in a great position, because if you have that information, you can then navigate the changes in the law, because there will be changes in the law. That part is inevitable. So I think it's very smart to just work with somebody, understand objectively what the business is worth. That way you can be proactive.
Well, and I think that we see most business owners that we start to see, you get to a certain level, you might get to 1 million in sales, you might get to 5 million in sales or 10 million. And you get to a level where you do start to, get better accounting in place. You start looking at monthly reconciliations or quarterly, reviews of the financial data. And so we're talking about, like, as you progress as a business, you get to certain levels where it is now sort of one of those things that you have to consider, even if you don't have family in the business, even more so if you don't have family in the business, but you want your family to be provided for because you're going to exit the business, or you're getting investors, you're part of a partnership and you're going to exit at some point, and they're even going to buy you back out, right?
Right.
And it is, where are those shares sitting, right? And we'll talk about trusts and we'll talk about some other types of things. But what we normally will see is, at that point, you start to get a regular business valuation. You start to look at it on an annual basis and start to peg yourself and say, okay, and sometimes it's internally, right? Sometimes you're just like, hey, we're doing our own numbers, right? And they're maybe calling us and being like, hey, what is the market multiple in the landscaping business right now, or the electrical contracting business, or the, nuclear power plant business, whatever it is. They'll be like, what is the reasonable multiples, which you've just said is between 4 and 7 of EBITDA, which is the bigger issue, obviously. Like, hey, here's the multiple, but what's your EBITDA? So can they just kind of take those multiples of the industry and be like, I think I'm at a 5 multiple. I actually think I'm at a 10 multiple because I am super special and I do something that nobody else does. There's nobody like me, right? Can I just go and apply that and say, hey, I'm going to give you some stock and I value it as 10 million because I'm really unique. I'm a unicorn, right? Is that reasonable? And quite frankly, that's where people start, so what does that gives them a frame of reference, but is the frame of reference correct? Is it a correct starting point? I think is the question.
I think your point about, the unicorn and, hey, I do something so different. I mean, you and I both know it's the transferability of that company. You could be a unicorn and you personally, as the business owner, could be the unicorn, and that's a problem, right? Because then there's no transferability. So I think I've seen a lot of times people putting value on maybe parts of the business that are not as valuable in the market as might be thought, right? So that's one big hiccup that can come along. Using multiples can also be misleading. I mean, like you just said, we had such a broad range, that we just spoke of. And even databases. Now, when I value companies, yes, I use a market approach. I look at multiples. There's GF data, PitchBook, deal stats, a lot of different databases that we use, right? The issue with those is there might not be comparability, because a lot of times those transactions have maybe synergistic aspects to it. You could, that EBITDA multiple could be based on future earnings that we have no visibility to. We don't know. We don't know a lot of times what the aspects or the deal structure was. So there's a lot of aspects to those multiples that might not be comparable to our company. Also, multiples for industries are very broad. So you could be, the construction, and I mean, you can drill down and find multiples for niche markets, but sometimes it's harder to find those niches. So you could have construction, you could have professional services, but if like you said, you are, a unicorn in your industry, it might be hard to find transactions that actually show you what an objective multiple would be for your company. The other thing is that we're talking average multiples. So there is always a range, and whether or not you trade at the lower end or the higher end have all to do with things that people in the market place value on: transferability, sustainability of growth, sustainability of cash flow, right? So people are putting, you don't have visibility to what those companies that made up those higher and lower range of the multiples are, unless you've worked with a valuation professional that has all of the detail to see, hey, you line up with the profitability maybe of the lower end or the higher end, or maybe an average is appropriate. The other thing we run into a lot, because business owners spend so much time in their businesses, they spend so much time at maybe industry trade shows, things like that, conferences. They're very well connected within their industry. So they a lot of times have colleagues that they know, bought their or sold their business, for 5 times, 10 times, whatever EBITDA. And the reality is that seems to be the most common multiple that business owners get in their head. And it's probably because, we're all competitive by nature, right? So, if your colleague sells it, then clearly that's what you're going to say. Okay, I know I can sell it at least for that. But that really is not the best thing to rely on, because you really don't know until you dig in and see who that buyer was, right? That could have been a synergistic buyer. You might not have access to a competitive buyer or something like that where they did. So relying on your colleagues and what they sold for, and honestly, like they may not have sold it for that. I mean, you just don't know. So I would say that is not something that I would suggest relying on for my personal estate planning. I would want to know. Well, and the other thing is too, if you had to give the value of your company to the IRS, which is what they require, it has to be substantiated. A qualified appraiser is not going to say, well, that so-and-so's, colleague in the industry sold it for 10 times EBITDA, and that's a market indication of value. That's not how that goes down. So we have to actually look at databases. We have to look at comparability within those databases as well. And a lot of times valuation professionals use a market approach as a corroborating method for the income approach. So a lot of times we're not really even using those multiples. We back into a multiple, right? So
yeah, sometimes it's like a sanity check, right?
Yes. Thank you.
Yeah. Well, and I think it's interesting because people get really hyped on multiples, like 3 to 5 times EBITDA. That's what I'm worth. And I say, this is a math equation. And there's math in this. And that multiple is one piece of the math, but the other math is the cash flow. Yep. So I'm just saying, do you want to sell, do you want to buy a company for 5 or 7 times cash flow? And they'll be like, well, I don't know. Like, what's the cash flow? Exactly.
I know.
And I think that what people don't understand is to go through the business valuation, what we're actually doing is it transferable? And how can it be, and could it be transferred to somebody off the street? Fair market value is kind of willing buyer, willing seller. Right. So it would be me. I don't know how to mow a lawn yet. I could buy a landscaping company. And why would I buy the landscaping company? It's got to provide me some benefit. It's either got to be cheaper than it would be to start it on my own, or it's got to have some already made clients, or some already purchased equipment, or some already made cash flow based on something. And so I think that when people are just looking at multiples, they're not looking at the whole picture and the cash flow. Again, you're going to pay $1 million for a company. Do you want it to be cash flowing 100,000 or 500,000? The multiple is going to change depending upon, you're still going to pay 1 million. Do you prefer half of that be from cash flow to you or not? And that, I think, is really the exercise. Talk a little bit about, if you remain the unicorn, what is transferable? Your clients, what is transferable? And at that level, though, you do have a team. So how deep is your team? Right. What other things do we really look at? Because you really have to look at it from when you go to sell, like that's trying to get the highest value, right? You're trying to work that value up. When you're transferring, sometimes you're transferring a minority interest. Sure. Sometimes you have discounts. Like part of the exit planning or estate planning has to do with some of the discounts. And that's another question that I think people come in and they'll ask you, say, okay, Amber, I need a valuation for an estate. What's your discounts?
Yeah.
What are you going to be? Because that's all. Like a lot of estate planning attorneys or other people are just like, well, what's the discount? Can I get higher than 50% discount? And, I think it's a 60% discount because, I'm a unicorn. Like there's nothing else. Like, what do you say when that kind of conversation happens?
Yeah, people will ask, what are you typically going to discount that at? And honestly, yes, there's typically a range, right? I will never say, because it's the empirical studies, it's getting into the nuts and bolts of the company before you can, and the provisions of the operating agreement or the limited partnership agreement and those kind of things, how that, if they're transferring a minority interest, all of those things matter greatly in how the company is going to be, or the interest, I should say, is going to be discounted if we transfer it. We should probably talk about why we want to transfer that in a second. But I want to go back to what you were saying about, the transferability of the company and your comment on, the cash flows. It's really important for a business owner not to, why multiples? We like multiples because they're easy to, everybody understands them, right? But, valuation is basically cash flows over risk. And the risk of a buyer, or even just if we're doing a fair market value, hypothetical willing buyer, willing seller, is the transferability of those cash flows. And can we keep those cash flows going into the future? Because an investor is buying future cash flows, not historical cash flows. And so trends are to keep founders on, for a duration, because a lot of, value is tied up in those founders. So we've got this issue where we've got to keep the founder on longer because a lot of that value is tied up in that. But that's the risk that's going to be assigned to those cash flows.
Yeah. And so, I probably got too excited and went a little too far, too fast, because you're right. Before we even get to that point, but that is, if you talk to somebody, they might be like, oh, we're going to go and get the discounts, for this estate planning. And, in essence, you can get anybody to prove up big discounts, but the IRS may not go for it. And so what we're trying to say though is, how your cash flow is happening. Yep. So if your cash flow is increasing, then you're going to be in a situation where you could have that taxable estate be higher because your cash flow keeps on going up, and that value exponentially goes up because of the multiple. But let's look at it from this perspective. What's the why do I even care? I'm just gonna, because a lot of business owners don't think about retirement. Yeah. They don't think I'm not going to sell my business. I'm going to run this until I die. It's for my kids or my legacy, or, they have a good management team. Maybe they do an ESOP situation. But what's the tax impact for a business owner upon death if they have not done estate or succession planning? What have you seen kind of in big terms for the family, really? Or it could be for a spouse, you might even think of it in that capacity.
Right. Yeah, we see that a lot. If there's not been any planning done, and this kind of illustrates why you want to do the planning, because we needed to think about the exemption as being both estate and gifting. So when you and I are talking transfer, we're actually talking about gifting that, right, to whatever, however we do that, to a trust or whatever. So just some, round figures. So let's say I've got a company that is worth $15 million, and that's an objective opinion from a valuation professional, right? Because you can't tell the IRS what you could tell the IRS what you think it's worth, I think. But in order for that to and we'll talk about adequate disclosure and that sort of thing. But so let's say it's worth $15 million, and that's from a valuation professional. We've got $3 million in real estate and personal property, and we've got $2 million in cash and securities that are more liquid. So we've got a $20 million estate. So as the law is now, the first 13.61% of that is exempt. So we got 20 million, and 13.31 is exempt. So that leaves us with 6.4 million being subject to that estate tax. So the highest marginal rate of the estate tax is 40%. And it's a graduated scale, but it goes to 40% pretty darn fast. So if we have a $20 million estate, right, as current law, and this is a single taxpayer, our tax on that is going to be about 2.5 million. So if the current exemption sunsets to that 7 million, so basically half, our tax in that situation is going to be 5.2 million. So under current law, with that situation, $20 million estate, $15 million tied up in the business, you've got a $2.5 million tax bill upon your death under current law. And if the estate exemption sunsets in 25, then we've got a $5.2 million tax bill. So in that scenario, I think we said we have about $2 million in cash and securities that's liquid. So in our first scenario, we owed 2.5 million. In our second scenario, if we sunset to the $7 million exemption level, you can see we kind of have a liquidity issue. So a lot of business owners, their business is their largest asset, and an operating business is not the most liquid of sorts, right? I mean, it takes time to sell a company. It takes time to find a buyer, all those sorts of things. So, we've got a liquidity issue in this scenario, and, we could have a situation where we have to do a fire sale. That's no good. And there are provisions in the tax code that help a taxpayer out to pay that estate tax over time if that happens, so you can avoid a fire sale. But it's kind of like with real estate. I mean, you've got a lot of families, or a lot of taxpayers have a lot of their estate tied up in non-liquid assets. And, in that scenario, you're dealing with an estate tax that's over and above what you have liquid to pay for that. So just in that situation, so we're talking about a $15 million company, a $20 million estate under current law. Tax bill is, what do we say, 2.5 million. And then if it sunsets, that's 5.2 million. So that's a pretty big delta if this does sunset.
Well, and it also presents like you only had 2 million in cash, and you welcome air. The unicorn dies tragically on a bicycle accident and doesn't have any estate planning, and you inherit a company, some real estate, and some cash, right? Mm-hmm. And that's the value at whatever the person passes, and fair market value. Now you have 2.5 million of taxes that you owe, and you only have 2 million of cash. So you either have to sell the real estate or you have to sell the company. Mm-hmm. And the company has provided the cash flow for the family for a long time. So if we sell the company, we're out of the cash flow, and the company rents the property. Mm-hmm. We really can't sell the property because now we could go get a loan or something like that. And now you're moving into a debt hole, like all of these things change. And you as the business owner have to understand that, that is some of the planning, is to prevent somebody having to do that in a probate court. Right. Yes. And having to prove out that. Now, you mentioned something earlier about, why do you do a business valuation? And we're going to talk about it as you go into how, the ways that they can transition. But a lot of times if you're doing something that has to do with the IRS, so you're gifting or you're transferring, into another entity that you own, or, transferring real estate out of a company into its own separate company, any of these types of things, you are producing a business valuation from an accredited appraiser to set the statute of limitations with the IRS. So you're, and a lot of times, any attorney or CPA that you talk to is going to recommend that you attach that valuation to the tax return. And even like one of my favorite friends, Mike Gregory, he talks about how even to put an overlay on the front and say, hey, IRS, this is what we valued. This is how much it was. Here was the discount. Here was the, like all of this to kind of walk the path, but you're setting the statute of limitations so that the IRS has 3 years to come and look back at this and say, was it good? Was it not good? Here's the substantiation. And obviously you're keeping it in your records, but that's the it isn't arbitrary. It is a suggestion to kind of cement that value and protect that value. But one thing that we can't typically do is just create no value from cash flow. And so if you have a business that is cash flowing, it's very hard to say it's worth nothing when the IRS has seen it's created these assets, right? It's tossed off enough that you've acquired significant assets. So, if a business owner has identified that, yes, I'm somewhere in that, I've kind of, because a lot of us don't want to face that. It's the same for estate planning personally, moving things into a trust, planning for your kids. It's the same concept for a business owner. but how can they use some of these estate planning concepts to transition their business out of their estate? Or maybe they don't even know, like most people just think I sell it to my kids, I sell it to my cousin, I sell it to a competitor, or somebody comes knocking and I get sick and now I got to sell it really fast. What are the ways that they can transition this business out of their estate or into some other vehicle?
Sure. And so, I mean, if they sold it and they didn't do any planning, you're swapping assets for assets. It's still in your estate, right? So you sell it. Well, now you got a lot of cash, but it's still in your estate. So you're still going to get taxed on it if you die with it, right? So if we're hitting the exemption, so let's just work with, 7 million, say it sunsets, and we're a single business owner and we've got a $7 million exemption. So we can transfer assets out of our estate so that our taxable estate is under 7 million. And that's what we're trying to do, is to get usually appreciating assets out of our estate. Okay. So let's say and I would always suggest working with a very smart, seasoned, board certified estate planning attorney in doing these. But let's just say you had a $10 million company sitting in your estate, and then that's an objective value. And you have, as a single business owner, and let's say it's sunset, so we're making a big assumption here because we don't know, that the exemption is $7 million as a single taxpayer, and you have a $10 million company. So just one way of that I've seen is, an estate planning attorney recapitalizing a company into Class A voting shares, Class B non-voting shares. Maybe the Class A owns 1% and the Class B non-voting owns 99%. So if we were just going to take a pro rata approach to that, 99% of a $10 million company is clearly over that exemption of $7 million, right? But the provisions that are associated with those Class B non-voting shares, the economic reality of those, we can transfer those non-controlling. I mean, it depends on the provisions of the operating agreement, clearly. But let's just say it was written so that, these Class B non-voting shares have no, clearly voting rights. They have no ability to manage the business. They cannot unlock the value of the underlying assets. They cannot control distributions or cash flows or anything. They have no rights. So that's going to be a non-controlling interest. And then we also have issues with marketability associated with those interests as well. Maybe they can't be transferred except to a permitted transferee. The holding period could be indefinite. We don't know if we're going to get distributions, right? Because distributions kind of combat that holding period because you're getting interim liquidity. But so within the provisions and within just the economic reality of the Class B non-voting shares, we apply as valuation professionals discounts for lack of control and discounts for lack of marketability to that interest. And so therefore, let's just say, and I have no idea what the all-in discount would be, but let's just say it was 30%. Then we have 30% discount on a 99% interest is going to get us just under that deduction to transfer over. So now we've transferred over, roughly $7 million into maybe a trust. And we have that remaining still sitting in our estate, but we were able to get some of that out of our estate. So it's important also to understand that exemption is for estate and gift. So you can gift that much in your lifetime as well. So it's not just, when you die, that's your exemption. You can also gift that amount during your lifetime. So that's what that exercise we just did, is somebody gifting a portion of their estate into a trust to get it out of their estate so that when they die, their estate would be under that exemption amount. And they did that by utilizing the gifting.
And I think you've given the example of pretty much a very widely used system of taking the business stock, if you will, and transferring it from me as an individual owner into the trust that owns it.
Mhm.
And now the trust is made up as me as the 1% controlling owner of those assets, right? And
Well,
then
the 1% still sitting with you as the owner in your estate. The trust owns the 99%.
yes.
Yeah. Okay. Yeah.
So I still own 1% of the trust, and that controls then what's happening there. And then the 99% can be gifted or given ownership, because it's still just ownership in the trust. So you have to understand, I think, that these are complex structures, and they change, like the trust mechanisms, like we're saying trust, right? As if it is one vehicle. And that's why typically you have an attorney kind of involved. You might have an accountant filing that gift tax return. You have an attorney kind of cultivating. You might have a business valuation person valuing it. It is a significant process, but you're also trying to save million. I mean, the goal is that you're saving millions, or you're saving the heirs to have $1 million fee or to have to liquidate. It's to kind of preserve the continuity, just like we put our individual assets into a trust. Putting business assets into a trust is also a concept in the business world, and using it to transfer majority of ownership, but not majority of control. And so that's where it kind of delineates it.
That's a really good point. I think, what we typically do see is the minority shares being transferred and the business owners still keeping control. And I think you also make another good point that these are very, very complex transactions. That was just like one example of hundreds that could be used. And an estate planning attorney is going to ask you, what are your goals? Most business owners do want to maintain control. They want to understand, hey, what is the impact to my heirs if I gift all of this to them? A lot of business owners or wealthy individuals do get concerned about what is actually being transferred, or equitability within the estate. So, I think it's important to understand that there's so many different ways to do this, reasons to do it, goals to be accomplished. And it's just very important to work with seasoned professionals, and making sure you're working with a good CPA as well to file the 709 or 706. So 709 is for gift, and 706 is for estate tax when you file those. But I 100% agree with you. These are very complicated transactions, and it's good to have a good team by your side.
Yeah, and it's specifically estate planning and strategic, like you could call it strategic planning, but I think that you have to be mindful that a lot of people will be like, yeah, you're strategic planning to sell your company. I think that very rare, and the idea of gifting the company is also a little foreign to some people,
Right.
So there could be provisions of that you're still keeping a lot of the profit, like there's a lot of layers to these that can kind of be understood. And some of them are legal layers. Some of them are IRS, like tax code layers. And so again, there's also, I mean, typically when you are having the business valuation performed, like talk about why it's necessary or beneficial when you're transitioning. I know we talk to a lot of business owners about starting to get a regular, even if it's a small valuation, even if it's just the, analysis or working with somebody to do a calculation, every year, or I provide like rubrics for companies and be like, hey, you guys are smart people, like you can go ahead and calculate this. And each year they're still like, I feel like we want, like we're really kind of a neutral third party. So when they're having these valuations performed, like, what do you think the benefit of them, are in this transition? And we've talked about some of the reasons to even have it for an IRS standpoint as well.
Well, and I don't know, I mean, Melissa, in your practice, I think probably one of the biggest issues, I don't know if you think this, but I think just taking the emotion out of it. It's like, let's just have an objective, like you just said, an objective third party looking at this, right? So that is going to get you probably a more objective opinion of value. But I think tracking, like you said, year over year, hey, let's see where we're at. Are we kind of getting to where we should probably think about doing some succession or estate planning? Because we're kind of getting to where your total estate is getting to that exemption amount, right? Are we seeing that? The other thing that I think is really important is if you do decide and work with a estate planning attorney to transfer some of those business interests, and you are going to file a 709, like we said earlier, the IRS requires to start the statute of limitations, that 3-year statute of limitations, a qualified appraisal from a qualified appraiser. So that statute of limitations starts when that is filed, the 709 is filed. So the IRS has 3 years to argue that value. If that's not filed, they can argue that value until you actually have an estate tax. So they could say, hey, now that you've passed, we really think that transfer was, 20 million when you said it was whatever. So, and then you've got to deal with that. And that probably would not be real fun. So, I think there's a lot of reasons to use an appraiser. I mean, most a good estate planning attorney is going to require you to have a qualified appraiser for this issue. They've seen too many, or they're not going to put themselves in that situation, right? So I would say just that old adage that knowledge is power, and what you measure, you can manage. And as a business owner, these brilliant people I get to work with every day, I just would love to see them really take it by the reins in all aspects, and really retire with confidence and knowledge that they have done the best that they can, also with their estate, with their heirs, and really maintaining that wealth that they have worked so hard to build.
Well, and I think that again, when we get involved, it is to preserve that value and to kind of set it in stone. And it is being proactive in that, there's a lot of attorneys that can provide you with knowledge about this. There's also those same attorneys could even file the income tax return, the 709 or the 706 is going to be if there's a death, like those types of things can all be handled. They can't necessarily sign off on the value. And you could list a value, right? Mm-hmm. You could list a value and even do a valuation and not assign it. But what we've kind of figured out in the profession is if we do these steps, it preserves that value, it protects it, and it establishes that like anybody can come 20 years later and say, oh, that was actually really cheap back then. Like we didn't know, but if we did know, of course it was, like nobody's going to believe that. So it's doing it in the time frame that is relevant, that is going to be most necessary, because you're preserving it in that time frame too. So sometimes, they might do it within the same year or use a valuation as a peg, like, oh, we had a valuation 5 years ago. That's not always going to be supportive of the value as you're gifting it, so that's also a timing, so it's kind of like, do you want to be conscious of the cost now or mindful of it? And I would even recommend working with somebody that is a little bit more strategic, that really is looking at this holistically from maybe an accounting, a business, a legal perspective, and not just putting something on a piece of paper. Because, like for the discounts, I will tell people I won't go above 45, as a total discount. You really have to get me to understand. Now, has there been a couple occasions that I've gone, yes, but it was like a startup situation or a situation that just had a round of funding that proved that, yes, this company just did a round of funding, but it also has an amazing amount of debt. Usually at that capacity, you have like high hopes of the future, but it hasn't come to fruition. Like that's
Sure.
the prime time of kind of transferring that asset in any capacity, but that's going to transfer the asset at a good rate for the IRS. You don't want to sell it at that point because you believe in the future and you believe in 3 years from now, it's going to be amazingly killer.
Yeah.
And most business owners believe their company is worth a lot more than it actually is worth anyway. So they're coming in saying, oh, it's worth 10 million. And you're like, so you make $10,000 a year.
Yeah.
So like, I'm going to need to understand how this is worth 10 million when I'm only going to be positive $10,000. Like, so I need to pay all of, like it has to make sense.
Sure.
In the wide scheme of things as well.
Sure. Absolutely.
But are there more provisions that you think are going to impact and that are planned to sunset that will impact business owners that they should at least be mindful of? We might not go into more detail or maybe a future podcast.
Yeah.
What else should we be mindful of that's happening in this wonderful act?
So, well, I don't know if you do a lot of valuations that are annual, but when the marginal tax rate went from 35 to 21, it was like, whoa, like, I mean, you see, and all else being equal, the tax rate, I mean, valuations went up, right? So everything else being equal. So, when that happened, when the corporate tax rate went down to 21%, so people would do S corps, right, to avoid double taxation. And so when the corporate tax rate went down, we used to do a lot of S corp premiums and valuations, and that kind of went out of vogue because there really wasn't, a benefit tax wise because the corporate tax rate went down to 21%. So what the IRS did to kind of combat that, the benefit of an S corp essentially kind of went away when they decreased that. They enacted the qualified business income QBI, and so that's reduces. So it allows a QBI deduction on qualified business income for S corps. So that is set to sunset as well. So also the marginal tax rate, all of those provisions are really relevant to business owners. So there's a lot to watch out for, and if action is taken, these could be extended, but we shall see.
I think that you brought up more, because what I think people don't understand is as these things change, valuation changes. Like the root, the general construct is still cash flow, but all of these things could change as well.
Yeah.
And again, you don't have to do anything in these capacities. You don't have to proactively estate plan, but it is a way that with those discounts, because you're gifting a minority or non-controlling interest as well as a non-marketable interest, right? Like it's not as easy to sell 1% of a trust that I don't own. I can't even control the company or the assets, right? So that, like, who wants that? Well, do I receive cash? Do I receive dividends? Do I receive benefits? How does this benefit me? And it's usually not at the capacity of a full owner. But in general, it's just being mindful that these business valuations, they don't have to be these huge things, and they don't have to be, it's 4 times my EBITDA and I think my EBITDA is whatever I want it to be. It's really, and some of it is even cleaning up the books, like maybe not working with all those discretionary expenses, or I like to say, can you start calling them, like, can you start putting them all together so that we can exclude them, like starting to clean out your personal usage of the company. Some of these things are just what you should be doing if you want the longevity of the company. But it doesn't mean that you have to. It means that, there's benefits in strategic planning as well. And to me, those valuations are kind of like, I don't know if I want to do a gift or a sale. Let's first determine what my value is. And like, oh, what? what? That's
Yeah.
it? I'm not going to, like, wait, like sometimes it is a reality check too, right?
For sure. I think you make a good point with those discretionary expenses. Most business owners run their company to lower taxes. And why wouldn't they? But when we start to kind of back out those things, and the other piece of that, I mean, we haven't really gone to the sale side, right? But you got a buyer, they want to know what it's truly worth without all of that. So going through the exercise of having somebody dig into the books, really understand what's going on, kind of clears those skeletons, right?
Yeah. And you don't, I mean, we had some clients come in recently, and when they looked at the financials to give to us for the business valuation, they noticed a huge 7-figure issue, 8-figure, whatever. It was it was over $10 million issue, and they knew it. And obviously it was of such a size for this company who did not even do 10 million in revenue, to be like, what happened? Like, our books spit this out and I don't know why. And where it, like, it's wrong, right? It was a weird inventory or a weird number, right? But it was like, I don't know why it's wrong. And you don't want somebody coming into the business and kind of looking at that. So it is kind of cleaning it up. But in general, if people want to go about this process, I recommend asking some questions, or reaching out. Do you allow people to reach out to you and contact you? Could you tell us a little bit more about maybe you and what you focus on, and how they can connect with you if they have questions? Because we've covered a lot of stuff, ma'am, a lot.
Absolutely.
And, yeah. So tell us more about you and what brilliance you can provide.
Sure. So I am partner of Business Valuation and Advisory with Seidel Schroeder. Seidel Schroeder is a regional accounting firm in Central Texas. We have about 120 employees. We've got 3 offices here in Central Texas. I specialize, of course, in valuation as well as transaction advisory, so quality of earnings as well. Help business owners, estate planning attorneys, and wealth advisors, and just help with these planning tools, and help business owners and high net worth people just make the best of their situations.
Well, and that's, I think, brilliant. And although I don't really believe you need to hire somebody in your area, I think that you can really work with anybody regarding valuation and financial things, because this is really a federal issue as well. But I think that you really have to find somebody that has some of the intelligence around maybe your industry, or intelligence around, business valuation doesn't even have to be industry specific either. It's really understanding, in my mind, it's almost understanding of like what a business would actually sell for, So we appreciate all of your information, and we'll hopefully have you back very soon.